Hello traders, Gary Wagner here. It is 12:20 in Honolulu, 5:20 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 18th day of November, 2022, and this is the daily report for gold and silver, our weekend review. Traders, unquestionably, at least for the short term, we have seen gold hit a resistance area it could not overcome on Tuesday when it traded to an intraday high of $1,792. On Wednesday, Thursday, and Friday, all 3 days contained lower pricing, and today gold is currently fixed at $1,752, down $11 or 0.62%, basis the most active December contract. We do have an open order to buy on a limit with a stop. We sent out a trade alert this morning addressing where to change the stop to and how to adjust the limit order we have in. Our premium subscribers simply need to go to the members page and they can get all of the information. However, you should have already received your trade alert via email as well as SMS text message. Now, the decline in gold happened concurrently with dollar strength. The dollar itself gained almost 0.25%, 0.24%, and is currently fixed at 106.845. Lastly, silver closed unchanged. The net change is 0%, with December silver futures currently trading at $20.97.5. Traders, this first chart is a daily chart of gold futures. It includes three moving averages, the 50, 100, and 200-day moving averages, as well as rectangles around the recent highs and lows in the market. The first thing that I do want to talk about is the moving averages themselves. When a market is in full bullish alignment, moving averages will always lag behind actual real-time data because intrinsically they are averages based upon the past. But for a market to be in full bullish alignment, you would always have the shortest term. The 50-day would have the highest value, followed by the 100-day, which would then be followed by the 200-day. As the market hit a top and then began to come down, you can see we had the 50-day move to the bottom, the 100-day to the middle, and the 200-day staying on top, which means that we are in full bearish alignment. Realize that I do believe we have seen a pivot to the upside, but these moving averages will not reflect that for a little while. I have removed the three moving averages so we can focus on recent highs and lows. We hit the record this year of 2,078, and from that point, we had a series of lower highs. They were consistent and they were consecutive, a total of 4 lower highs following the March high that came in, as I said, at 2,078. In terms of the lows, we went from this one high here to the first low, which was then followed by 2 additional lower lows, and the third lower low was actually converted, as I say, into a triple bottom. Although they weren't exactly at the same price point, they were very, very close. And then we had a very strong pivot to the upside. Beginning of November marked the point in which we shifted from a bear market to a bull market. In terms of the fundamentals, you had statements coming out once the CPI numbers for October came out, showing that there was a downtick from 8.2% year over year to 7.7% year over year. And so we saw a pretty strong rally, taking gold from these lows at $1,621 to Tuesday's high of $1,792. From there, we had consecutive days in which we saw the price decline. As I said, the bullish market sentiment was due to a downtick in the CPI numbers. It was perceived that the Fed would take their foot off the gas pedal in terms of the amount of rate hikes and their aggressive monetary policy. But recent statements starting last Sunday, as well as a statement today by Fed President Bullard, all conveyed that they're not done raising rates. Bullard actually said he wouldn't be surprised if they raise their benchmark rate to 7%, and that brought gold down to its current pricing. Which brings us to our current assessment and the unique circumstance we find ourselves in. As I said, we had this series of lower highs up until this most recent high. This is obviously above this high here that comes in roughly at 1730, this at about 1825. That is a dramatic change. We now have to see this correction that I believe is now in swing have a higher low, which is going to be pretty easy to accomplish because a previous low was 1621, and I believe that this is leg one of the rally. I believe we will have a correction that will come in at some point. The areas we're looking at, of course, are the 23.6% at 1750, 1725 is the 38.2, and the 50% retracement comes in right around 1700. But when the correction completes, I believe it will go into a long wave 3, and that will take us to a new high above this high. In other words, I believe that the pattern of lower highs is going to flip to a series of higher highs and higher lows. The exact prices that I'm looking at are where we put our limit order in and are reserved for our premium members in terms of our trade alerts that we send to them. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.